Cue the music. Cue the ACDC.
I can't believe you drove it.
All right, I'm just going to start talking because we're rolling. So it sounds like all the excitement's coming at 1 o'clock with the NARS discussion. So I'll do like the pregame. I got some new cards. I've got a shiny new QR code that a client can apply through that. So I'll pass those around. I brought some ink pens that everyone seems to love. That use judiciously. Don't lose them. Don't give them away. They're really expensive. Not everyone gets these pens, so
These are exclusive.
only the special folks get them. So, but no, thank y'all for having me as always. I love visiting with you guys. I feel like I'm talking to 360 here. You all truly have something different here, and I just love what y'all are all about. And I know Kate, you're new, and Daniel too, but it's a special group, and just love being affiliated with you guys and what all you're about, and not only how you serve your clients, the community, and it's just a wonderful, purpose-driven group. So I just love being a part of it. So thank you for that. I thought I'd talk a little bit about the rate environment, because that seems to be a topic that everyone wants to talk about these days. You know, rates have improved, which we're super excited about. This week, mortgage refinance applications were up for 35%.
Wow.
I think that there's a lot of people who have been watching rates over the last year, thinking, "Gosh, when are they going to come down? When are they, we need to refi this 7.5% rate or whatever it was when they got it a year or so ago."
Yeah.
And so now I think it's starting to look like some people are now kind of in the money to look at that. It is a case-by-case situation, so I think, as you guys, as your past clients might ask you, it really, it may not make sense yet. I think some people might want to, we all think, I think the rates will continue to come down. What we don't want to see clients do is jump into a refi and then rates drop a little more than they're sold it again, and then they're just incurring all these extra closing costs. Whereas if they just waited a little bit, they could kind of hit that optimal. It's hard because you can't time the market exactly, but the rule of thumb, and we did a ton of I think a third of my business in 2020 was refinance transactions.
Oh yeah.
I think in fact it was a little, I think it was like 35% of my business was refis. And so we did a lot of these calculations, okay, because there's a break-even point, right? There are costs to do a refi, and so generally, if you could save a client a point and they're going to be in that house or have that mortgage for at least the next 2 to 3 years, 2 to 3 years is often the kind of the break-even point. So if y'all have clients asking about rates, I'm happy to, send them back to their lender, but I'm happy to offer my feedback and run the numbers. It's just a math equation. Obviously, if someone's planning to sell the next year or two, it wouldn't make any sense to do that. They need to have time to recoup the benefit of having that lower interest rate. But something we're hearing an awful lot about these days. So currently 30-year fixed on a conventional loan is about in the mid-6s. We're seeing that a little lower in some cases. They have a large down payment. Obviously, there's what's called loan-level price adjustments, where on each individual loan level, there are price adjustments to a rate that are specific to that client's situation. And so some of those adjustments might be where they fall in the credit score band. So if they have a 700, their pricing is going to be different than they have, say, a 760. The govies, FHA, VA, USDA, those programs are fortunately a little more forgiving with rate. So with credit score. So if we see someone with a 6-something, their rate may not be as impacted as much as if they will get a conventional loan. So that's positive on the government side. And we're seeing those. I mean, we've seen some down below 6%. We've seen some they started with a 4. If the clients really want to pay some points and drive that rate down, we typically don't encourage folks to buy the rate down too much, because if rates do drop more and they choose to refi to an even better rate, then all that money they spent on that rate reduction it's just going to be money down the drain. So they just need to know what their options are. I mean, we were competing against Rocket Mortgage on one the other day, and it was like a 4.99 rate that it came with just a crazy amount of discount points. Money the client really didn't have. I mean, they had it, but they're buying a house too, and so is this really the best use for this money, or because there could be other expenses they really need that money for?
So, when you say that Rocket Mortgage had on that many discount points, was that being told to them that they were going to have that behind the scenes? Like,
I don't know how the conversation goes with them. They did on their estimate; it showed that because they have to show it on the loan estimate. But oftentimes these internet lenders, like we'll just call them internet lenders.
Yeah.
A lot of these out-of-town lenders will get the client interested with that rate because a lot of people are just purely all they think about is rate.
Yeah.
And so it's our job to educate them. It's a lot more than just interest rate. There's the fees involved. APR was that's a regulatory thing. We have to disclose rate and APR because APR is really the great equalizer when it comes to comparing mortgages. APR will include not only the interest rate but the cost of the loan amortized over 30 years, so you can really compare apples to apples. So a client needs to ask that question. If the rate's this, okay, what's the APR? Because that's going to tell the full story, along with a fee estimate that's going to break down all the costs too. But yeah, they're on there. But a lot of times clients don't. They just see that rate. They see the rate, they see the payment, and that page 2, the loan estimate there's a lot on there. All the recording fees, the title fees, transfer taxes, title insurance, all that stuff, and in there somewhere is going to be the discount points. And if they're not really analyzing that, sometimes they can be, they don't catch it, or they just don't, their eyes go back to that rate. So they just need to be educated. THDA, that's a flat rate for any borrower who's getting 100% financing through the state bond program. That's 6.375 right now, which is great. So if you qualify for THDA, you get that rate, whether you have an 800 score or a 640 score.
do you typically see that lower than, like, if the rates fall, will that fall too?
They will, yeah. They will. They usually don't move unless there's like a big movement in the market. They won't change that. But we'll see THDA publish their rate change maybe once every week or two versus other mortgage rates can change throughout the day, minute by minute sometimes. But a little less movement with those. So a couple of y'all I was talking to or chatting with prior to just about what's interesting or what might be something. Matt's not here. Matt was asking. It said might be just talking a little bit about appraisals. How I don't know if y'all see this with properties that are being financed with a government loan like a VA or FHA. The appraisal, when there's an appraisal ordered, there's a case number assigned to that appraisal, to that property for that appraisal, and that appraisal will stick with that property for 6 months on an FHA or VA loan. And so if we get a client who's looking to buy a house and there's already been one assigned, we have to have that case number transferred to us. But that appraisal will stay with that property for 6 months. So I don't know if y'all seen that much or wondered about that. But that's we run into that sometimes. It's like, so if one lender can't do the loan, we get it. We have to get that case number released and transferred and all that. So, and usually lenders, there you are. I mean, and usually lenders are cooperative with that. They'll you too, brother.
I was bringing that up too because during the VA scare, where everybody was scared to, as a listing agent, to let somebody with a VA loan come in because if they got the name who should not be named, that curse would be on the property then for an FHA loan.
Mm-hmm.
So that's when I had never even heard of that until someone was like, "Well, we're hesitant because of this," and then we worked around it, but it would be helpful. So.
Will you summarize what Matt was saying, Dave?
Yeah, so, and that's a good point too. So, talking about VA appraisals in particular, there's one particular VA appraiser who's been notorious for invoking tidewater on a property where that might be, debatable, where there's not sufficient comps of that property, and so it looks like the appraiser hasn't maybe given it a fair shake on finding appropriate comps. And we're in East Tennessee, and so parts of our area, it might be harder to find adequate comps. About to go out a little farther, and so I think what this appraiser's been accused of has been really quick to going the tidewater route. I don't know why it's really called that, but it has to do with insufficient comps for that particular property. So in that case, in that case, if that house goes under contract by another buyer, that appraisal stays with that property. Is that what you're saying?
Yes, that way even if you get the bad shake and somebody comes in there, they get that guy, he values it like 70, 80,000 under what it was.
Yeah.
Whoa, we can't make it work, and that was the only option for them. It dies, and then somebody else comes. Well, I'm an FHA. Well, that appraisal is stuck on it even.
But would it be, if it's not a VA though?
I didn't know if it was, and that could be a good question. I didn't know if it was only VAs stick with VAs,
Yeah.
or if it was VAs that stuck and would apply to FHA and VA, or is it only loan product to loan product?
I think it's just loan product. So if it were an FHA buyer, I don't think that would apply.
Okay, so it'd only be if somebody else was coming in with a VA loan.
Right.
Okay, so then you could bypass it, but if somebody was good enough to do like a just 5% down conventional type thing.
Right.
You can't call for a reappraisal, I think.
Not if it was like a VA type thing. I don't think it's stuck on the property.
For
So,
6 months, yeah.
even if you're like, let's redo it, then be like, well, if you want to go with this loan product, this is what the appraisal is for 6 months.
Yep.
That's crazy.
So, which could be, if it were another veteran, obviously that'd be an issue.
Yeah.
But,
That's the thing too, where I see like a lot of lenders are like, these listing agents, why would they ever fight a VA loan? The VA loans are great, but I think that's probably what made some people hesitant was the Lone Ranger who was coming in there and saying like, oh, we're just shooting it real low as a listing agent. And you're like, well, I don't want to tell my person, oh, it's a VA loan, it's real great, and then you get that guy, and then now you're stuck at that. You waste all this time in the market, so it was good to know like all of the things that you passed essentially.
yeah,
At
and
any point, was he held accountable for that, or like fined, or modified?
not that I know of. Yeah, from what I've heard, he's been supported by his office. I mean, his work's been justified. We haven't seen his work lately much. So
Maybe he
us.
fell off the face of the earth.
Well, I don't know. Yeah, I haven't heard any recent stories after that. Have y'all had him lately?
No, he's been
Probably.
I haven't seen too much of him.
Yeah.
I think some people have just kind of put him on that list. And I think it helps that he's probably not super helpful, just all around,
Yeah. Things generally have a way of working themselves out over time. Matt, you also asked about new property. I guess you were referring to a new construction. Can a VA loan be used to buy a new construction home?
A lot of the questions is they bought their home with a VA and they're still paying on it and they want to buy another home, like they're looking to upgrade or something. Can they, in the meantime, get something under contract? A lot of times they need to sell that house in order to buy, but technically you can't have two homes with VA.
Well, you actually can.
Yeah, that's where
There's what's called bonus entitlement, and I'm not an authority on this subject. I could certainly probably learn more about it, but I'm working with one client right now in particular who, this is interesting, bought a house with a VA loan, lived in it, because you have to on a VA loan, right? Moved and bought another house using bonus entitlement on another house, kept that house with the VA loan, turned it into a rental. And now is looking to buy another house with a VA loan, but it's going to have to sell this house. So they have this in as a rental with a VA loan.
Okay.
Bought this with a VA loan, wanted to buy another house with a VA loan, but they're going to have to sell this house to free up the entitlement for this house.
Oh, okay.
So you can
Yeah,
have
good one.
multiple VA loans.
Okay.
But There's a formula on their entitlement, yeah. And so you gotta be sure there's enough entitlement there for the new house, yeah.
How does that work with USDA loans? Because I know you can't have two USDA.
That's correct, yeah. Yeah, so USDA is a wonderful program. I think USDA was created as a first-time home buyer type program. And really to incent borrowers to buy in the country in the more rural areas. And so it's a wonderful loan. It's 100% financing. The PMI is very low. It's probably close to a third of what FHA PMI is. The funding fee is almost half of what the FHA funding fee is. And the interest rate is really, really good. It's probably similar to FHA financing. But if you own any other real estate, you can't qualify for a USDA loan. So that's the limitation there. So if you had a USDA loan, you want to buy another house, you have to sell that one first.
You have 100% finance zone.
You have to have a contingent, yeah.
Okay, so if you're like, I own this home USDA, we're going to buy this bigger home over here.
Yeah.
You can,
You can,
as long as that wasn't the sentence.
yeah. Yeah. So, yeah. Good question. We talked to Matt. You were asking also about, or maybe Callie, about closing costs. How much? I know that tends to change. People wonder, how much closing costs can a seller pay for, depending on the type of financing.
Yes.
So, conventional, a lot of times you see 3% being the max, right? If they're putting 10% down, it could be 6%. If they're putting 25% down, it could be 9%. So something to remember, it's not just limited to 3. Most of the time, a lot of borrowers are buying, putting 3% or 5% down instead of 4. It is 3%. But it can be more. The thing we love about FHA and USDA is it's 6%. So there's buyers that, like I talked to a guy this morning who literally has no money and they're wanting to buy a house and they want to go to USDA. And so we talked about how 0 down, you can get up to 6% paid by the seller, and that should more than cover. In fact, it could be used to pay, maybe buy the rate down some, and that's a wonderful way to help the buyer get into. So if it's a $200,000 house, that's $12,000 that can go towards closing costs and buying the rate down. So.
And then at that point, what conversations do you have with them, or if you're a newer agent of the USDA program and how that is financed, and how you can get it to that point? Because of the grant program, what do they need to qualify for?
So there's 2 types of USDA loans. We only do the guarantee. There's the direct that you go through like a Eastern Aid.
Yes.
Which right now I think they don't have the funds. Or I was talking to Kip. Do y'all know Kip?
There's no more funds.
Yeah, there's no funds for that.
Maybe
Yeah.
a year or 2.
Shoot.
Right. So I actually had a client come to. They were going to use them. So we ended up doing a loan for them for I think we did a 3% down, or no. Yeah, 3% down conventional, but we just do the guaranteed, which is just your traditional USDA. The direct has a lot more restrictions on income limitations. I'm really not that familiar with. There's some things that make it much more constrictive.
You send the report to the lender too, and they tell you what needs to be fixed.
Okay.
So like an inspection report, you would have to see it as USDA direct and be like, okay, this needs to be fixed. You
Okay.
figure out how it's fixed.
Okay.
And if they're like, well, we don't want to fix it, then it's dead.
Right.
It's
Okay.
the only time ever I was like, are you sure I send this to the lender? They're like, yeah. I was like,
Wow. Yeah. Yeah. We can't do that. We can't. I don't think we can. I think it has to be through like a community development, whatever, CDFI lender or something like that.
Yeah, they've got their thing, but it's great if you qualify for it, but there's no
Yeah.
funding right now.
Well, and then finding a property too that the price range and
Yeah.
in the county and
Well,
competing against
It's
investors.
hard to, you can do it. It's hard to compete when you're like, oh yeah,
Yeah.
what I got here is a loan at the fastest we can close is 45 days. I've got to send the lender the inspection report, and
Yeah.
choose us. We also need some closing costs.
Right.
Also,
Yeah.
the house
It hasn't been the best
not
market
too
for that.
expensive for somebody going with a direct.
Yeah.
No, because even
Asking for things to be fixed.
I've helped people and they've bought expensive houses. You can buy really nice.
With direct.
Yeah, they get qualified. So I had someone that qualified with Eastman, qualified for 80,000, and their monthly rate was gonna be something. When I had them get qualified through, Eastern 8, they were qualified for, I think, 275, and it cost the same amount each month for the principal and interest. It's just because it's so subsidized. Now, if you start making more money, you start to lose some subsidy, even in like what the payment is. So it's not like you can be like, oh, we're barely getting by, and then you get an upgrade, you start making a lot more money, and then you keep it. It's meant to just help people that aren't really making that much and get them into a better house, and then the subsidy slowly kind of goes away.
Yeah. Yeah, I think, clients need to know what they're getting into. Same with THDA, like if they get the grant of 5,000 or the, that's gotta be paid back if they sell the house or refinance. Wonderful program. You just need to know all the strings that are attached with it. So investment properties, there's a 2% limit to what sellers can pay. So I think sometimes that gets tripped up. We'll see contracts come in where the seller paid, it ends up being like 3 or 4%. It's like, well, we got to back that down on a rental property to 2%. VA is a little trickier. It's depending on what underwriting you ask. But I've been told there's no limit on the amount of seller concessions that are paid on a VA loan, and then there's also some verbiage in the VA guidelines about 4%. But then you can go over that in certain cases. So the feedback I've received is it truly can be unlimited. So, it depends on what kind of debate you want to get into with an underwriter on it. But that can be one, I think, from what I've experienced. So have y'all seen that much with VA loans trying to get a bunch of seller pays?
I just had before where the buyer wanted 6% of seller paid, and they were like, "Oh, we can only do 4."
Yeah.
And they were just stuck there, and then like they really showed me the guideline, and I know trying to get past the guideline, but they were just like, "No."
Yeah.
So
Yeah.
that was
So our ops folks, we've gotten good feedback on that. So I feel like the guides should. I read them this morning and I was like, they should make these a little more clear.
yeah. You have to do some finagling to get it.
Yeah.
covered.
What are you seeing in the market as far as like what's your common buyer right now? Price point, location, are they coming from somewhere else?
Yeah. And you asked about appraisals too, over, under, if we're seeing that. I had one guy. So I have a guy right now who's from Johnson City, spent his whole adult working career in the Atlanta area, and is retired, and now he's wanting to buy in Kingsport. So he's under contract on the house. It's $435, and it's a really nice built house. It's very dated, but it's a good sized house, brick in a nice neighborhood, and it appraised for $470. So 35 over. So he's just ag about it,
Yeah, good.
And appraisers, I think, will tend to try to hedge some anyway. So, so that's a good sign.
Yeah, that is.
But he's going to fix it up and make it look really nice. I'm sure.
That can help our
Sure.
conversations too. If it's an average thing, like, well, if you do wait for the interest rates, this is also good. If we go now, you're actually pulling into equity if you're getting the loan on something, versus you're gonna have to pay that over, and then you're not gonna have a lot of equity if our market is gonna boost like that.
Right. Yeah. I mean, I think people who are waiting for rates to come down are just going to see more buyers get back to the market. Because I think there's some who are starting to get off the sidelines, but a lot more who aren't. Still there's people who have 2.5%, 3% rates on their houses that just don't want to sell. I was listening to a podcast today about Canada. Canada, you can't have a 30-year fixed rate. It's like a 3 or 5-year fixed rate, amortized over 20 or 30 years. But and so they're just having all kinds of problems with going from a 3% to a now 5 or 6% rate. And what that does to their housing market and values and everything. But you know, we're there's such a wide range of buyers. You know, you got, you know, we're doing some VA stuff. We have a lot of conventional, FHA. I think it's just kind of all over the map. I mean, have one closing tomorrow for $740. It appraised at $750. It was non-contingent, so he had a house in Piney Flats. He's wanting to win that. This is a very nice house that, you know, in a good neighborhood. That he had to make his offer non-contingent, and thankfully he was able to do that. Some people can't, you know.
Yeah.
But won the deal, and that one's closing tomorrow. Yeah, it's kind of all over the map. Have a duplex right now. Talking about appraisals. Have a duplex. Y'all know Danny Santucci. It's this guy's buying a duplex for $575,000.
What?
And Danny's like, hey, big guy. You know, he's like, I don't know that I can do this. So your typical appraiser that's not a certified general appraiser. He's not really equipped to do an income-based approach appraisal, and so they're looking more at comps, you know, comparable markets solds in the area. And he said, man, you know, if you look at duplexes that have sold, or even, you know, in the last, you know, within a certain mileage, all that kind of thing, there's like nothing.
Or under like 400,000 probably.
Right.
At the top.
Exactly. So it's going to take a lot more analysis on the income side of things. And so that one got reassigned. I don't even know who it is, but they're doing it. I think they did it yesterday. We'll have a report back about the 20th. And I'm really interested to see, and it's an FHA loan. So, you know, they're going to do a market rent analysis for the property as an FHA loan.
It seems super high.
Very high. Now it's very nice. Very nice. It was built 3 years ago. Yeah. But $575.
Golly.
Yeah. So we're hoping that it comes in close.
With a gold couch. Conveys with the property.
Right. We've seen several appraisals come in at like 1,000 over, 5,000 over. I've seen very few, if any, under. So are y'all seeing that much? Just any values coming in low? I mean, I don't think that's gonna.
I haven't seen it at
I
all.
mean, it can happen, I guess, but it might happen with this duplex. But overall, we're not seeing that. What else? Let's
Are you
see.
seeing a lot of heat walks and like bridge loans, like with people? And what,
Yeah.
like I know the difference between the two, but as far as like, and I know it's probably circumstantial, but like what do you see more that people are choosing? And I know but the big differences between the two. What would be more beneficial? For
Yeah.
someone?
So there's a lot of lenders won't do bridge loans because they're taking two pieces of collateral, and oftentimes in different markets. When I was in banking, we would do them, but we wanted to do them as long as we had a physical presence in both markets. And there's not many banks that have physical presence in, you know, in wide territories like that. Some banks would want to do it as long as they have one in their market. But it can be, a bridge loan is a good program. It can tend to be a little more expensive for a client because they're doing, oftentimes they'll require appraisals on both properties, title work on both properties. But I mean, in theory, it makes a lot of sense. You take the deed of trust on the house to sell, as long as there's equity there, on the one they're buying. You do interest only payment for say 12 months or 6 months, and they can renew it for another 6 months or whatever. And then once the house sells, they just pay down the principal and convert it to like a regular mortgage. We had a call this morning. We're talking about bringing on a bridge product. What I tend to be a fan of, and I've done this for a lot of clients, is coaching them to get a HELOC. Because a lot of these banks or credit unions will do them for no closing costs. Now, when they pay it off and sell it, then they may have to pay like a $500 cancellation fee or something like that to recoup some of the costs. I've seen the most success with that because it's pretty cheap to get them.
Yeah.
And then they can get better terms on the mortgage versus getting a bridge loan and not really knowing what their final terms are going to be. Sometimes those are variable rates, and you don't know what your rate's going to be until you finalize the permanent mortgage. So see a lot of just with people moving across country, not wanting to sell first because they don't want to do a contingent. That's a very common thing. People doing home equity type stuff, but they need to remember that HELOC payment is going to have to be calculated in the debt to income ratio calculation. So they got to be able to qualify once they get that HELOC in place, plus the new mortgage, plus their other debt. So it all has to math out.
Gotcha.
Yeah.
Is it any different if they use it for investment property that you want?
No, I mean same kind of thing. It just needs to be. They got to be able to qualify with that HELOC payment. And that HELOC payment, some banks will be a lot more conservative in how they look at that. They'll assume maybe that it's termed out over say a 15-year period, with an even higher rate than this. I've seen that, and it can be very punitive to a borrower. Us, we just go by what the credit report or what their note says. So if it's interest only, it's just the interest, which is helpful sometimes.
Now, this is just, so if you were to recommend that to somebody, like they're buying an investment property, just take out 20% so they can get a conventional on the secondary?
20 or 25. Pricing gets a lot better at 25% down on rental properties, I found. But, with rates coming down, it may not be as big a deal to refinance. One thing too, though, with HELOCs, there's, the technology is getting so much better too, and the agencies, Fannie and Freddie, are looking for every reason in the book to make lenders repurchase loans. I don't know if you've heard much about this, but every loan's getting audited these days. And what a lot of mortgage companies are getting repurchases for is because a client used a HELOC at the last minute to fund their purchase, and that payment was included in the debt to income. And so once you include it, throws the DTI up, and therefore it's an ineligible loan to Fannie or Freddie, and the lender has to repurchase the loan, which is no-brainer. If you have clients with HELOCs who are trying to do something, on the DL, that could come back to bite them. So, what other kind of questions do you have, or topics of interest? We can do HELOCs. We have a really cool vendor called Figure Lending. You can do it first, second, or third lien position on primary, secondary, or rental properties.
Can you go over the difference between somebody doing a cash out refinance and then a HELOC, and what the difference is, why one would be more advantageous than the other type deal?
Yeah, so a HELOC versus a cash out refi. And a HELOC, you could do it just a closed-in second mortgage, just a term loan too. There's that. I think a lot of people who have a mortgage right now, it's probably, unless they bought in the last 18 to 24 months, it's probably a really good interest rate. 3, 2.5%, 3%, 3.5%. And so to do a cash out refinance, you're talking about losing that incredibly low rate. People don't want to do that, and I can't blame them. Not to mention when you do a cash out refi, you get an even more of an adjustment on your rate because there's enhanced perceived risk that the lender doesn't really know they don't really know why that extra cash is coming out. So you get a price adjustment on the rate on a cash out. So whereas a HELOC could be a wonderful way to tap that equity without having to mess with that first. The downside of the HELOC would be maybe it's a variable rate based on prime. Most banks right now issuing HELOCs, I would say, it's going to be prime plus a margin of maybe anywhere from a half a point to 1 or 2 points or even 3 points, depending on credit score. So, we've seen HELOCs with the 11 or 12% rate, which almost sounds like a credit card rate. I mean, not really, but it's just, you'd think on a home loan you'd get something much lower than that, but that's, prime's still 8.5. The feds have all but guaranteed, or the expectation of feds will do loan rates in September by probably 50 basis points. So there's a direct impact to HELOCs when that happens. So that'd be good for people who have that kind of debt out there. I don't think, with the rates, with the Fed cutting rates, we're not going to see them come down nearly as fast as we saw them go up. So if people were thinking, oh man, we're going to see rates get down to really low, really fast, it'll take time. They'll creep down, and especially if we don't have any kind of crazy economical, bad things happen. I mean, it's just, it might be a slow decline in rates, but welcome nonetheless.
Yeah.
Welcome nonetheless. So, and as that relates to our world, we're, mortgage rates and the Fed funds rates are not correlated, but they are somehow, kind of loosely correlated, I guess. I guess they're not. It's not causational where Fed's lower rates, our rates drop. So the anticipation in the bond markets, if the Feds are going to cut rates, is that those reductions in mortgage rates kind of already been priced in. So there's a anticipation rates are going to come down. We see rates come down. So that's a little bit of what we've already seen. Rates have come down a little bit in anticipation of what the Feds are going to do. So in September when they cut the rates, it's not like, oh, our rates all of a sudden drop too. But it's kind of already been priced in. So, I can keep talking, but I better wrap up. Thank y'all for having me.
Thank you.